Welcome to the Deep Dive. Today, we're zeroing in on Smith Micro Software, that's ticker SMSI.
Yep, we're looking at their second quarter 2025 earnings call. Happened after hours, August 6th.
And it was a really interesting one, wasn't it? Kind of a classic financial puzzle.
Absolutely. You had this significant beat on the bottom line, the EPS number, but then the top line, revenue, actually missed expectations.
Right. And the market reaction was, well, pretty positive after hours, which seems counterintuitive with a revenue miss.
It does, but investors seem to look right past that miss. They focus squarely on how the company's running things, the efficiency, and this new strategic direction they laid out.
Okay, so that's our mission today for you, the listener. We're going to unpack that split, that EPS beat versus the revenue miss.
And figure out why this strategic pivot got the market excited enough to push the stock up, even with softer sales.
Exactly. We'll go from the balance sheet cleanup right into what they're planning with their main product, SafePath 8. Let's hit the headline numbers first.
Sure. So earnings, non-GAAP EPS, came in at a loss of 14 cents. Now, the key thing here is that the consensus estimate was for a loss of 25 cents.
Wow. Okay, so they beat by 11 cents. That's pretty significant.
It really is. It signals much tighter financial control than analysts were expecting.
But then there's the other side of the coin, revenue.
Right. That landed at $4.4 million. The expectation was closer to $4.68 million. So a miss.
And not just a miss, but also down compared to last year, right?
A 14% decrease year over year. So, on the surface, not great.
So how does that happen? You miss revenue by nearly 300 grand, you're down 14% year on year, and the stock goes up.
Well, the answer pops right out when you look at the gross margin. This is what the street loved.
Okay.
Gross margin expanded to 73.5%. That's 480 basis points higher than the 68.7% they had a year ago.
Nearly 5 percentage points. That's a big jump in efficiency.
Huge. For a software company selling through carriers, that kind of margin strength is vital. It tells you the mix of products they're selling is better, and they're spending less to deliver the service.
So that's the nugget. The market saw that margin, saw the efficiency gain, and basically prioritized that over the slight revenue miss from the past quarter.
Exactly. Their betting management has found a stable, profitable way to operate each unit, each subscription.
And that didn't just happen, right? There were deliberate cost cuts.
Oh, definitely. Non-GAAP operating expenses were down 22% compared to last year. That's aggressive cost management.
And that's how they narrowed the non-GAAP net loss to $2.8 million.
Precisely. Cutting costs significantly while holding that strong gross margin is the path to narrowing losses.
So when we talk about operating leverage, especially with a gross margin that high, like 73.5%, what does that really mean for the potential profits? For you, the listener watching this.
It means that every new dollar of recurring revenue they sign up, maybe through AT&T or T-Mobile or Orange, is incredibly valuable. Their fixed costs, developers, servers, that kind of stuff, stay relatively flat. So a huge chunk of that 73.5 cents from each new dollar drops straight down towards covering operating costs.
Yeah, right.
Once they get enough revenue to cover those fixed operating costs, the break-even point, which these cost cuts are helping them reach faster, well, then profits can really take off quickly.
That explosive potential is the hook then.
That's the catalyst investors are looking for in a turnaround story like this.
Now, we have to address the elephant in the room for anyone looking at the official filings. The GAAP loss was enormous, right? Something like negative $1.78 per share.
It was, yeah. And that difference between the GAAP loss of 78 cents and the non-GAAP loss of 14 cents is jarring if you don't know what's going on.
So what is going on?
It's almost entirely down to a non-cash charge, a big one. An $11.1 million goodwill impairment.
$11 million on $4.4 million revenue?
Yep. It's like wiping out 2.5 quarters of revenue in one accounting hit. But it's non-cash. It's basically saying, okay, some acquisitions we made in the past aren't worth, on paper, what we thought they were.
So like cleaning the slate.
Exactly. It's painful accounting medicine, but it often signals management is getting realistic, cleaning up the balance sheet, and aligning asset values with today's business. The market often sees it as a necessary step before a real turnaround.
And speaking of cleaning up, they weren't just doing accounting adjustments. They actually sold off a piece of the business.
They did. On June 3rd, they sold the ViewSpot product line. Got $1.3 million for it.
ViewSpot. That wasn't related to family safety, was it?
Not at all. It's about retail display analytics, completely non-core. So selling it does two things. Brings in a bit of cash, obviously.
Right.
But maybe more importantly, it removes a distraction. Management can now focus like 100% of their time and money on the main event, SafePath
Mm-hmm.
And those carrier relationships, it's about focus.
I get the focus part, but let's talk about that cash. Even with the $1.3 million, ending the quarter with only $1.4 million in cash. That sounds razor thin. Doesn't that undercut the whole margin story? I mean, what if they run out of money?
That is absolutely the high-risk part of this story. You're right to point it out. It was tight, which is why the market probably breathed a sigh of relief when, in July, after the quarter closed, they did another small fundraising, a follow-on offering that brought in $1.5 million gross.
Okay, so another $1.5 million?
Yeah, it's not huge, but it's a crucial near-term bridge. It buys them breathing room, buys them time to get these new SafePath initiatives generating revenue and hopefully cash flow.
And there was a leadership change too, signaling focus.
Right. Tim Huffmyer came back. He's now COO and CFO, effective June 9th.
Dual role.
Exactly. Bringing back a respected operator like him into both finance and operations. That usually signals a serious push to tighten things up, execute better, focus on delivery.
Okay, so we've covered let's say, the cleanup phase, the cost cuts, the divestiture, the shoring up of cash, the leadership tightening. Now let's shift gears, because management spent most of the call looking forward.
They really did. The past was acknowledged, but the excitement was all about the future, the SafePath growth engine.
And that started with guidance, right? That's what anchored the positive reaction.
Yes. They guided Q3 revenue to be between $4.5 and $4.8 million. So ticking up slightly from Q2.
The start of a turnaround.
That's the hope. And crucially, they expressed confidence they'd see sequential quarterly revenue growth, meaning Q3 higher than Q2 and Q4 higher than Q3 through the rest of 2025. They think they've hit the bottom on revenue decline.
And what's driving that expected growth? The big news seemed to be SafePath 8.
Definitely. SafePath 8 is launching later this month, and it's packed with AI features. This isn't just a minor update. It's a significant push using AI.
Okay, tell us about the AI. What specifically are they adding?
3 main things they highlighted. First, social media intelligence. Using AI to monitor kids' social media, not just for keywords, but for patterns of risk, potential bullying, behavioral stuff, and alerting parents proactively.
Okay, that sounds more advanced than simple filtering.
Right. Second, and this is very timely, AI blocking functionality.
Blocking AI itself.
Yeah, specifically aimed at restricting chatbots, tools like ChatGPT, Gemini, on a kid's device. Management thinks this is a key differentiator for parents worried about that tech.
I can see the appeal there. What's the third piece?
An AI assistant. It uses large language models to let parents query all the data SafePath collects. Instead of scrolling through logs, a parent could ask, summarize my daughter's online time last week, or where is my son near when he tried to visit that blocked website?
Turning data into actual insights.
Exactly. Making it easier to understand what's happening.
But it wasn't just about the app, was it? They talked about moving SafePath onto the device itself. SafePath OS.
Yes. And this is a really big strategic move. It opens up potentially huge new markets for them.
How so?
Well, first, for dedicated kids' phones, they've made software changes to make it much easier for carriers to adopt. Things like no inventory required integration, default settings out of the box, less friction for the carrier.
Makes sense. Less hassle for the carrier means faster rollout.
Right. But the really intriguing part, maybe the biggest opportunity, is adapting that same SafePath OS technology for senior phones.
Senior phones, using the same base tech.
Yep. Simplified interface, location tracking, maybe emergency features. They expect the first shippable version for seniors by the end of Q3. So, very soon.
And did they say how big that market could be?
Get this. Management said on the call that their carrier partners believe the senior market opportunity could actually be larger than the kids market.
Wait, larger than the kids market? That's huge. That's not just adding a feature. That's potentially doubling or more than doubling their addressable market.
Exactly. If that pans out, it's a fundamental game changer for SMSI's potential scale. They're taking their core skill, integrating safety deeply with carriers, and applying it to a massive new demographic.
Okay, that explains a lot of the excitement. But is it just talk, or are carriers actually engaging? Did they give updates on current partners?
They did provide some specifics. With Orange Spain, the rollout is ongoing, and they're planning a big marketing push timed for back to school, focused on a specific rate plan called TWIO.
Okay, so optimizing existing deals.
Right. And in the U.S., AT&T is apparently increasing marketing, doing cross-promotions with their Secure Families branding.
And T-Mobile, they're a key one.
The relationship there seems to be getting stronger. Management mentioned broad interest across T-Mobile, especially in SafePath 8 and these new OS solutions for both kids and seniors. So yeah, the big U.S. carriers seem engaged with the new roadmap.
All right, let's pull this all together then. Back to that initial question. Why the positive reaction despite the Q2 revenue miss?
I think it's crystal clear now. Investors basically ignored the lagging revenue number and focused on two forward-looking things. One, that impressive gross margin showing the business can be efficient and has huge leverage potential.
And two,
the very clear, very compelling product roadmap, the AI stuff in SafePath 8, and especially the potential explosion in market size from SafePath OS, particularly for seniors.
it's a bet on future execution then.
Absolutely. And you have to remember the context. SMSI is a microcap, heavily reliant on a few big carrier deals. It's volatile. You look at the broader software ETF like IGV, it's up maybe 32% over the year.
Yeah.
SMSI hasn't kept pace. It's been choppy.
High risk, high reward profile.
Textbook case. The company's narrative now is purely, we are the carrier's partner for family safety. Full stop. Success or failure hinges entirely on whether they can turn this pipeline, especially the OS stuff, into actual signed deals and growing revenue in the second half of this year.
Okay, that brings us nicely to our final segment. This is not financial advice. This is where we pitch a, let's say, bold but plausible trade idea for listeners who understand the risks.
Right. So the thesis, as we've discussed, is that the recent stock move is built on believing management can deliver that sequential growth in the second half of 25.
Driven by SafePath 8 and the OS launches.
Exactly. The big risk, still that tight balance sheet, the big catalyst. Massive operating leverage if revenue does accelerate against that 73.5% gross margin.
So given that setup, the risk, the potential reward, the leverage, what's the trade pitch?
It's a highly leveraged bet purely on execution in Q3 and Q4. The idea would be to go long SMSI common shares. Or, for even more leverage, potentially the warrants that came with that July follow-on offering.
Warrants are definitely higher risk.
Extremely. But this is a bet that the SafePath OS launch, especially for seniors, tapping into that potentially huge market the carriers are excited about, drives adoption much faster than people currently expect.
And if that happens?
If that happens, the revenue starts flowing, that high margin drops tons of cash to the bottom line, and suddenly the balance sheet concern just evaporates. It's an asymmetric bet. Downside, limited by the current price. Upside, potentially multiples higher if they execute this pivot successfully, starting now.
Got it. So to wrap up our deep dive on Smith Micro's Q2, key takeaways are the EPS beat showing cost control, that really strong gross margin expansion, the smart divestiture to focus resources.
And most importantly, that powerful pivot story built around the AI and SafePath 8 and the huge potential new markets with SafePath OS for kids and, critically, seniors.
Execution is everything now.
It really is. And before we go, here's a final thought for you, the listener, to chew on. With generative AI becoming so pervasive everywhere, will Smith Micro's new AI blocking tools and social media intelligence truly be long-term differentiators that lock carriers in?
Or are they just becoming the minimum expectation, the table stakes, required to even compete in the mobile safety space going forward?
Something to consider as we watch how this crucial second half unfolds for them.
Definitely food for thought. Thanks for joining us for this deep dive.
We hope this was insightful for you.